This is CFD Trading Insights. I'm Mark Lowdy. Alex Douglas from City Index joins us once more. Now, one of the things that you need to worry about when you're investing in shares is currency conversions, particularly if you're buying those shares obviously in another currency, in another market. What advantage or disadvantage can you then gain by using CFDs to either hedge or in some other way use that to help protect yourself against these forex fluctuations?
Well, of course, with the CFD trading platform, you do have access to markets around the world, but of course one of those markets is the foreign exchange market. And so just by making certain selections from the drop-down menus on the trading platform, it is very easy to trade currencies and to take steps to hedge the risk that you face if you are investing in foreign currencies. One of the things to consider, of course, is that if you are trading in an offshore market, if your home currency appreciates against that foreign currency, that is going to erode the value of your investments overseas. Now, if you've been making profits with your offshore investment, that's obviously a bad thing, because if your currency, your home currency, is getting stronger against that other currency, that's going to be eroding any profits that you happen to have made.
Give us an example.
All right, let's have a look at Citrix systems in the US. Now, let's suppose you're trading Citrix. We see a chart here with a blue arrow marking a point where someone may perhaps have bought into this particular stock at a price of $23.
Right.
And then over at the right-hand end of the chart, prices are trading at $26.78. So let's suppose that is the duration of our trade. On paper, it looks like a great trade.
Looks very good.
Buying at 23, selling at 26.78, nice little profit in that one. Okay, so if we are looking at this from the point of view of a person who holds their account in Aussie dollars, we've had a period coinciding with that trade where the Aussie dollar was strengthening against the US dollar.
Right, so this is the same chart duration we're looking at, but now we're looking at the Aussie-US exchange rate, and we're seeing that the Aussie is actually gaining quite a lot in strength, isn't it?
Indeed, yes, it had a very strong move there. Now, the same would be true if we're looking at any other currency. This is for a person whose home currency is the Aussie dollar, but if your home currency was the Sing dollar, then you'd simply be looking at a chart of Sing dollar against the US dollar.
Right, okay.
So, unfortunately, during the period that we had this Citrix trade in place, the physical trade, the Aussie dollar was getting stronger, which is going to have the effect of eroding the profits that we're achieving in our foreign stock. If we come back and have a look at the Citrix chart again, now we said that was trading around $23. Let's suppose we bought 280 shares in the physical market at $23. That's a face value on the trade of $6,440 US dollars. When we went to close out this trade, prices were $26.78. So when we sold our 280 Citrix shares in the physical market, we received $7,498.40, giving us a profit of $1,058.40 US.
Not bad.
Yep, nice little return. Now, if we leave the buy and the sell figures in place there and replace that chart with a chart of the Aussie dollar at the same point in time, Aussie against US, let's have a look at what the Aussie was doing. It was rallying, which is eroding the profits that we're making.
Right, because when we repatriate the profits, we don't get as many Aussie dollars for the US dollars as we did in
Precisely. So again, looking at when we entered this trade, back at $23, Aussie was trading at around $0.6440 at that time. One Aussie US, 64.40. So the face value in Aussie dollar terms was $10,000.
Right.
We had to put $10,000 of Aussie into this physical trade. When we closed out the trade and we sold our 280 Citrix shares at $26.78, the Aussie at this time had rallied to around about 76 cents. And so when we did the conversion of the proceeds from this sale back into Aussie dollars, we received $9,866.32. We actually lost $133.68 on this trade that was looking so good.
So even though in the physical market on the where Citrix is listed, which is the NASDAQ, even though we made such a nice profit of more than $1,000, when the investor brings the money back to Australian dollars, is actually down.
Unfortunately so, because of the strong appreciation of the home currency has eroded all those profits in the offshore market. Now, obviously in this instance, the danger that this investor faces is that their home currency will appreciate against the foreign currency. So what they need to do is to enter a strategy that is going to give them a profit if that danger in fact does appear.
Yes. So what's the solution?
Well, the solution is to buy Aussie dollars and sell US dollars, and to do so in a similar amount to the amount that we actually invested in the first place. So we had to put 10,000 Aussie dollars into this trade.
Yes.
So we want to buy 10,000 Aussie on the currency market and sell an equivalent amount of US, which is very easy to do on the CFD platform. You simply go to the currency prices and enter a trade there. So if we had done that, if we had bought 10,000 Aussie here at 64.40, that would have been the equivalent of US dollars 6,440. When we went to close this trade out, when Aussie was trading at 76 cents, we sell the 10,000 Aussie. In return, we receive 7,600 US. So on the currency trade here, we would have achieved a profit of 1,160. So if we put it all together in a table, we can see the end result here. So looking at the Citrix trade, we bought them at 23, sold them at 26.78. In US dollar terms, we made $1,058.40. But when we did all the conversions back into our home currency, in this case Aussie dollars, we lost $133.68. The FX trade that we took to balance out the risk of the home currency appreciating against the foreign currency was where we bought our 10,000 Aussie dollars at 64.40 when we initiated the trade. And then we closed that out by selling 10,000 Aussie at 76 cents. And we achieved a profit on that trade of 1,160 US dollars, which converted at 76 cents, gave us a profit of Aussie dollars 1,526.32. So we combine that with our little loss there on Citrix in Aussie dollar terms. We've walked away with a profit in Aussie dollar terms of 1,392.64 through the combined trade, which, interestingly, is the same figure, pretty much, as if we had just taken, if we just had the US dollar end result from our Citrix trade, our profit of $1,058.40, if we converted that at 76 cents, we would have ended up with the same figure of 1,392. So this shows you if you're trading physical shares or physical assets of any sort in an offshore market, you can hedge against the risk of adverse currency movements simply by using your CFD platform to trade CFDs in the currency market. But one of the really good features of trading foreign equities or foreign securities of any sort using a CFD is that it actually removes this currency risk. So you don't need to take on this hedging trade in order to remove the risk.
So you should have just bought Citrix CFDs in the first place.
In the first place.
And then you wouldn't have had to do any hedging with currencies.
That's right, because you don't have that conversion taking place when you actually enter the trade.
Why not?
Instead, what happens when you're trading a CFD, if you're trading Citrix on margin, which is the way CFDs work, when you initiate the trade, a small amount is set aside from your account as margin. Let's suppose it's 10% of the face value of the trade. That'll be in US dollars. Now, an equivalent Aussie dollar amount in this instance will be set aside in your account as margin. That amount will fluctuate from day to day as long as the position is open. The fluctuations will be caused by changes in the exchange rate and by changes in the value of the stock itself. When you come to close out the trade, all of that margin, initial margin, will be returned into your trading account. And then when you've closed out the trade, you'll be left with either a profit or a loss in the foreign currency. In this case, you'll be left with a profit of US dollars $1,058.40. At that time, you can then choose to convert the currency back into your home currency. With the City Index platform, we actually have developed it in such a way that the trader has the flexibility to decide for themselves when they make that conversion. So after you close out the trade, the profit or the loss will sit in your account in that foreign currency until you ask us to return it into your home currency. That way, if you've had not such a successful run and you've actually lost money in your foreign trade, if you're sitting on a loss but your home currency is appreciating against that foreign currency, the currency movement will in fact be reducing that loss. So you may prefer to wait in that instance and leave the negative figure sitting in your account until such time as you feel that the currency has gone far enough, and that way you'll be minimizing the loss that you're actually returning to your account. So by using CFDs, you can avoid the currency risk altogether if you trade your foreign securities with the CFD, or if you do have physical assets overseas, you can trade the FX side of the CFD platform to hedge that risk.
Thank you very much, Alex Douglas. And you can interact with us through this website. Click Apply for a demo account to try the City Index platform risk-free and discover the features of the live account. Or click here if you want to jump right in and apply for a live account straight away. To learn more about CFDs, download the 10 Golden Rules of CFD Trading by clicking here, or ask us any question you like about CFDs through this form.
You should read and consider the PDS before making any decision to deal in City Index products, which are derivatives. Derivatives can be highly leveraged, they can carry a high level of risk and are not suitable for all investors.